Okay, hello everyone and welcome to this month's webinar. It's our CBAM portfolio performance review and outlook for the next quarter. We've got Sam and Mark joining us today, and as usual we will have a short Q&A session at the end of their presentation, along with a small survey that will be left up for you guys to leave any feedback. So those of you who have 30 seconds or so, we would obviously really appreciate if you could. Other than that, guys, I will let you take it away.
Thank you, Jess. Yes, welcome everyone to our quarter three review and outlook. Yeah, it's that time of year where we've moved into quarter four, and yeah, it's been already a long and challenging year in the portfolios, but yeah, hopefully this will be a detailed review of the quarter that has just gone through. The main focus of this presentation, we've probably sort of choreographed this to sort of questions that have been coming through advisors, through meetings with many of you who are clients, and lots of that has been the new world we find ourselves in of higher interest rates, and those interest rates hanging around for longer, and potentially will be hanging around for longer than perhaps anyone would have thought earlier in the year. As I say, it's only 6 months ago where every strategist report on Wall Street was all fully committed to bonds and the role they were going to play, which is something that certainly hasn't played out this year with where rates still are. And Sam in particular has done a lot of work on the area of cash versus bonds, and what we think might be the migration that probably was due for this year that hasn't yet happened, and how that influences and shapes the portfolios. And then we sort of give a sort of regular update on the numbers, and probably a bit more of an equity outlook. And again, one particular fund-based holding that we've spoken about all year that comes to a very important quarterly period.
So yes, just as you see there, first of all, good morning. Thanks for joining us and giving us your time this morning. Yes, the usual important notices there. This is, we are a trading name of Ascot Wealth Management, an authorised body. And as a result, we are regulated by the FCA. And obviously, this is more an investment webinar rather than a tax webinar. For that, please contact your financial advisor. But today we'll be concentrating on the fund investment universe. And obviously, as we know, you can receive less back from what you put in. However, of course, that is not our aim. Looking across the webinar, we'll be looking at last quarter's portfolio performance and those factors that attributed to that. Before looking at quarter four outlook and strategy, really look forward to doing that. Spent an awful lot of time meeting fund managers lately and economists, and then of course looking at how we're positioned currently, but also a little bit of a discussion about where we probably be heading over the next few weeks in the portfolios, which I'm quite excited about. Looking over the last quarter, we see that we are down to a degree over the quarter, up to I think it's just up to 1%. Obviously, as you can see, it's been quite a turbulent quarter. A large part of this has been swings in the longer maturities, so like 30 years as opposed to say a couple of years. US Treasury bonds. So with more growth orientated funds, they have to discount their future cash flows by those. And as a result, their values have been swinging around quite a lot over the quarter. And not just that, I think a lot of people have been taking profit from, the massive outperformance of what became known as the Super 7, which powered a huge proportion of S&P 500 performance over the quarter. But over the quarter, relatively flat. Looking at the top and bottom performers across the quarter, if you look there, the worst performing funds is exactly as I just spoke about, those funds that are very sensitive to long end treasury yields were the worst performing. With minor exception of that would be the SP 500, although that is in a roundabout way, with US dollar rallying. I'll talk about that a little bit more in the slide in a minute, but that helped bring down the overall return of that a little bit. Whereas the best performing funds, as you see, there are funds that are far more less sensitive to interest rate rises. So high yield and the the FTSE 100 tends to be in sterling terms, outperforms when dollars appreciate. So that's helped that performance there. And also Japan. Is a really interesting area at the moment, and will continue to be for a few years. There's always been the story of increasing governance standards in Japanese companies, and that's really now starting to feed through in terms of more of a shareholder orientated approach rather than more worried about, say, internal management. So that's been proving to be fantastic, but also with Japanese yield curve control. So the Bank of Japan has a very strict level that they're willing to let Japanese government debt go above. And they're starting to loosen that up. And what that means is Japanese government debt bonds have been appreciating. What that means is that Japanese domestic investors are starting to think about moving their funds away more from the US and started to bring that capital back to Japan. Just to put into context, Japan actually has the largest overseas retail investment holdings in the world. So that could be a really quite powerful driver for Japanese equities over the next couple of years if that yield curve control continues to lift. At the moment, it looks like it might be free floating by around about April. Not sure what happened there, but we seem to have come down to my laptop rather than the usual screen. So unfortunately, I've have to look up away from the camera quite a bit. But yeah, so that's an interesting area to look at over the next couple of years. Will certainly be Japanese equities. Looking at performance versus AFI, unfortunately, over the quarter, negative in all 10 portfolios. A large part of that is due to our overweight on US Treasuries, which a large part of that is due to the outlook that we might be entering more of a slowdown in the US, but unfortunately that was outweighed by the rise in the tail end of the yield curve in the US, so that brought down our performance overall largely there. And just looking at where we're positioned at the moment, you can see that we still have our large positions on China, which will likely be getting reduced in the next couple of weeks, alongside, of course, North American equities. It makes up a massive part of the MSCI World Index, so obviously that's going to always be a large part of the portfolio, but that has been reducing down over the last few months, just as the sentiment around the US economy is starting to weigh up a little bit and people taking profit, as I mentioned, from those Super 7. As mentioned there, one of our large positions is in North American fixed government interest, which I will lead on to the reasons for its heavy weighting at the moment later on. And there's just where we sit versus benchmark. Just another way of looking at what I just mentioned on the previous slide. So how active have we been over the last quarter? Somewhat, as you can see there. I think added all up, it comes to over 20 trades, but also already leading into this quarter. You see we put 4 through literally on Friday, and I expect that to triple over the next couple of weeks. As we look at areas of the portfolio which we can add added value and stability if there is a continued slowdown, particularly in the lower down portfolios. but that's an area that we're looking forward to quite a bit. One thing that I point out is if I can just grab the annotate button. Sure, yeah. Is we've been increasing our weighting to have a short-term money markets twice over the quarter. So what that does is that brings in, it kind of responds very similarly to base rate rises. So as the base rate goes up, it pretty much tracks that. You don't get the duration capital loss when yields rise like you do in other bonds anywhere near as much. So that's been a really nice steady deliver of performance. At the moment, it's returning just over 6%. So it's just a nice way to just put 6% into your back pocket on that allocation at the moment. But there are areas that we think that you can add increased performance possibly over the next 12 months, which we'll bring on to in a second. So what happened? Q3 earnings season was, and is continuing to be actually, going into this quarter, so quarter four. It's been positive. US has just been a continuous positive surprise all year. Everyone's kind of waiting for the expected downturn to happen, and it just keeps on getting pushed out another 3 months. But we're not going to complain because obviously that keeps on bringing improved performance. In Europe, sentiment was improving in quarter three. That's now reversing. There's a real belief. I'll come on to the Purchasing Manager Index levels in the later slide, but they're very much now in contractionary territory. So we don't expect Europe to perform as great this quarter. And US inflation, which I'll talk about in the next slide rather than talk about too early here. Monetary policy tightening reached a peak question mark. I think it's not even a question mark. I think if there's anything, it's 25 bips now, and that's kind of it, unless there's a massive inflation shock. That ties in what I'll talk to again on US inflation in the next slide. The PMI data did improve beyond what was expected, but as said in this quarter, that's very much reversed. The sentiment has got a lot more negative in the market, but we're orientating to be a lot more defensive around that. Jobs data. Job market does remain tight, particularly in Europe and the UK. In actual fact, so a large part of what's been happening with rate rises is an effort to loosen up the jobs market. So that being, reduce down the amount of available job postings compared to the number of applicants. It's just a very tight market at the moment. In the UK and Europe, it's actually got tighter still. Since that effort first began. Unfortunately, I think in order to really nail core inflation on the head, there needs to be some way of loosening that. And unfortunately, that's probably going to have to be a recession. Increase the number of people looking for work and or reduce the number of available positions out in the market. It's a simple equation, and those are the two things that, in whatever proportion they may be, but that's what needs to happen. And then, sorry, that's a slightly older slide. That should actually be reversed. So sterling depreciated against the dollar last quarter, but that's more kind of the dollar has been really appreciating, starting to be a little bit of a flight to safety, but also with the higher for longer trade that's been happening in the US, and that's where the higher end, tail end of yields have been going up in the US. There's been a little bit of interest rate play going on there that's helped the dollar. So, talking a bit more positive after that negative speech, US CPI. So the latest figure for US CPI came out on Friday, I believe it was, which actually came in as a headline number, slightly above expectation. But this is where not looking at the headline number and looking deeper shows something actually a lot more positive. So shelter which is obviously a component of CPI in the US. The way that the Federal Reserve measures that has a real lag effect on what's actually going on in the economy. And the industry data says that actually shelter inflation in the States should be at or near zero now. So if you were to strip out shelter from US CPI on the Friday posting, it comes in bang on 2%. So what can you deduce from that is, if this continues as is for the next couple of months leading into 2024, as I said, foregoing any kind of inflation shock surprise, so another war, etc. US Fed is kind of to some degree mission accomplished on inflation. So that is a really positive piece of news. And at the moment, the market's currently pricing between 0.5% and 0.75% of a cut in the US base rate next year. So there could be some from that perspective, good performance from treasuries if that follows through, which would be really positive indeed to keep an eye on. And as mentioned there, it was actually the other way around. So the US dollar index there on the left-hand side, it's not a sterling only thing, it's against a whole basket of currencies. The US dollar has really appreciated on the quarter, this period here. But what's interesting is we're starting to get into the regions of the 2022, where basically the world just came to the conclusion that the dollar is massively overvalued. You even compare the current level compared to where we were before 2022, you can see already that there's considerable scope for US dollar depreciation in the more medium term, and that will obviously help US assets that are priced in sterling, and will help outperform. So that is an area that is short-term pain in retrospect, but in the medium term, looking forward, could actually be quite a positive tailwind. Certainly not a positive headwind. Let me just scroll down the screen a second. This is all a bit strange. Yeah, just showing how that affects, how the currency affects on UK large and mid cap. So what we got here is, in the blue is US dollars and sterling. In the green, you've got the FTSE 100, and in the red, you've got the FTSE 250, excluding investment trusts. And as you can see there, there's quite a clear, as US dollars depreciates versus the pound, we see very much that in the red, the FTSE 250 really outperforms the 100, and that was our case, how we were positioned going into the last quarter. But unfortunately, that reversed as the US dollar appreciated versus the pound, and as we see now, unfortunately, the 250 is lagged to 100 over the quarter by around about 2%. I think this is something that, if we are going to be more defensive looking into the next quarter, the overweight is probably an area that might be changed, just to say, because the 100 has a little bit more of a global outlook, and the macro data for the UK. When I've been meeting economists over the last 3-4 weeks, been very much been talking almost verbatim, repeating expectation that UK enters recession starting this quarter. So from our perspective, being FTSE 250 might not necessarily be where we want to be, and that's probably something that will be changing fairly rapidly. Okay, Mark, did you want to talk about this? Okay.
Yeah, so just a of note, we've spoken. This only affects V1 portfolio, so if you're in V2, this bit isn't so relevant. But yeah, one of our holdings that's sort of been a little bit more in the news on the quarter, and as ever, happy to welcome questions on its role in the portfolio and its objective. It was originally bought in as a substitute for bond yields, where this was sort of 6-7% dividend, and that's one of the factors that sort of has come into the news this week. So it's been a bit of a roller coaster quarter on the holding. The positive news, sort of just probably about a month ago, was that another music fund's assets got acquired for 65% more than the discounted value that many of these investment trusts have been trading in during this period. Investment trusts do act a little bit differently to the unit trusts that fill the rest of the portfolio, in that they can essentially trade at a discount to what the believed value is, and that's sort of one of the ways people enter and exit these positions. So yeah, in the space of a month, we've gone from very positive news, the fund rallying to I think 93, 94, and we took a view that it was 25-30% up on the week, and the other asset had been bought for 65%, so there didn't seem to be any immediate rationale for exiting that position. We always had our sort of target £1 level on that. Hypnosis then surprised the market twice. Firstly, with a buyback that looked cheaper than what many shareholders believed it could have done at, which again, it was an odd announcement, sort of 3 days after the positive news, and then probably more of a shock this week was the suspension of the dividend, which, as I say, was the main driver for holding this fund to hold something that was yielding above what gilt rates in US treasuries were at the time. So probably more digesting that news. We believe it's something they've been forced into, as opposed to something that needed to happen. Sam's had a super busy month out on the road in meetings like this. What's probably been in the news is activist shareholders, which are probably more common in the US than in the UK, but that's investment groups and funds that come in to buy stuff that they feel is distressed, and that they can become more involved in the direction of the business or the fund that they're in. So we've taken that as a positive. There's a very, very important AGM and vote at the end of October, so really all eyes will be focused on that. We've made a decision in house that we put this out to sell down and buy before, and it can trade at a very wide spread to what we think we're executing. So we've taken the view that we are going to hold this position till at least the vote that will on its continuation on the 26th. We still think a wind-up scenario, if that is what comes out at the end of the month, will value the asset at more than what it's trading at the minute. But yeah, year to date, that 30% rise was a 2.5-3% rise, which is why at one point during the month we were 2-3% ahead of peers. And yeah, unfortunately, it's given all of that back with about another 10%. So it's come again far off where it was midweek, and trades just beneath 70 with a rally yesterday. So yeah, just want to give people confidence, actively tracking it. We don't want to sort of trade it and get caught on a day with a disastrously wide trading spread. Our preferred route is that the non-continuation vote goes through, and we get a wound up fund and position in excess of where it is now, which as I say, it's I think 5-6% of the portfolio. So if we can get out that position back at the 90 level, it's another 2-3% return for those in V1. But happy to welcome any questions. I know questions have been coming via advisors, and there's been lots of good debates the last month or so. But yeah, that's probably just the relevant update for the quarter on Hypnosis.
Thanks, Mark. So I want to talk about something quite topical at the moment, actually, which is cash and money markets are very supreme over fixed income. Obviously, with deposit rates, kind of like 5.5% 1 year kind of deposit at the moment, I can understand entirely why that they're a very attractive proposition to a lot of people at the moment. But what I would like to just talk about is in a downturn scenario, actually, you can get some very useful returns from more like government debt, and also how you might actually be more exposed than perhaps you thought in cash to begin with. So first of all, just quickly talk about how did we get here to right now. So they pretty much track each other, as I've mentioned earlier, the Royal London Short-Term Money Market Fund and the Bank of England base rate, which we can see since the beginning of October 22. February 2022, has returned just short of 5%, whereas obviously fixed income and other areas have been negative. Now, why is that? So yield, if you're calculating yield, it's the coupon received divided by the capital value of the bond. And obviously, as base rates move up, everything fixed income kind of revalues around that. So in order to achieve the higher yield, because you're getting a risk-free return that's higher, the only way to get that higher yield is to devalue the capital value of the bonds. So that's what very much you saw particularly throughout 2022, but with government debt that's continued on the tail end, as mentioned quite a bit now, throughout 2023. But the thing is, though, is that we are now probably right at peak rates, as I mentioned. So how quickly is that going to happen? So one thing that if you go through rate rising cycles in the US, going back over 40 years now, you kind of start to see a trend, which is obviously the yields move up, so capital value of bonds go down as the Fed hikes, and then you end up with periods of a long sideways consolidation, which did actually happen throughout this year. What we've had is that whilst the short end of the curve has been fairly flat in real yield terms, the tail end's been moving up. So you've got this sideways consolidation that's been very much going on, especially over the last couple of weeks and months. And then you end up with a top in the 10-year yield around the final Fed hike. That is probably going to be this month or next month, the final Fed hike. So we could be entering that scenario 3 right around about here, right now. And then after that, you get the 10-year rallies. What does that mean? That means the 10-year yield comes down. So that figure is actually from June, but if you bring it to today's date, we see that the 10-year is really, really close to the Fed funds rate. And if you go back through all of the different rate rising cycles over the last 40 years, you will see that right now we're probably at that peak terminal rate for the 10-year. So what does that mean moving forward for the next 12 months, possibly for US Treasuries? So each individual bar here is a different maturity of US Treasury. Obviously, in the Vanguard Fund, that is the North portfolios, you hold a passive spread of these, and it works out as an average of 7 years, which is the middle bar in each of these situations. What we got going left to right here is changing yields of the of those bonds. But what does that mean as a total return? So changing the capital value plus the income that you'll receive from the bond. So if interest rates stay exactly where they are right now, you end up with this very nice 5 to 6% return on US government debt. However, as I mentioned, we've got 50 bips that the market's kind of expecting at the moment decrease. As you can see here, if we go a little bit more aggressive in terms of US Treasuries, we can end up quite easily with 12% returns, etc., on government debt. what I would say is at the moment is the market is still pricing in the US what's called a soft landing. If there's a little bit more of a recession, you could be heading more to the left-hand side of this graph, at which point, you know, on the longer treasuries could be heading up towards 20%, etc. returns. So yes, there's been, for the next 12 months on cash, you will be getting 5.5%. But on sovereign debt, there's potential for certainly enhanced returns. But if you're more cautious, we'd still be looking at the left-hand side of each of these blocks, and you'll still be getting over 6% return on US Treasury likely for the next year. Even if there is an inflation shock going upwards, yields need to rise more than 0.75%, which is at the moment seen as quite improbable. And the benchmark would still return a positive return. So I think that's quite powerful, that we're certainly behind the far more negative performance time when it comes to sovereign debt, developed world sovereign debt. And that now it seems that risk is far more on the upside for investors. And that, I think, means that we can help improve, you know, investor returns, and we can also start to think a lot more about how much fixed income do we want to hold in the portfolios. You know, I think at the moment one thing that investors find quite powerful is the idea of surety of returns, particularly in the lower down portfolios. As you can see, we can start to generate a little bit more surety of that return, and makes, I think, deposits a little bit less powerful in comparison. And just a very quick illustration there, before I quickly move on, because I'm going through my slides a bit too slowly, of, you know, the typical returns that happen during downturns. As you can see there, you know, when the tech bubble collapsed in the early noughties, which, to be found in NASDAQ, you could argue that that is still in the bubble even after last year. You know, you're looking at 17% return on US and so on and so forth. So there's definitely a hedging way of returns here that can help support portfolios, which I find quite powerful. Why am I talking about US quite a bit? So during COVID, as we all know, we were all fortunate enough to save some money. And in the US, they got helicopter money. They literally received checks. The government literally paid people. And that generated an awful lot of excess savings, as you see on the left-hand side. Now, that graph kind of shows that they're halfway through spending all of that money. It's not that simple. What you're finding is that the top 10%, etc., has still got all of their excess savings. Kind of like the lower and mid to lower people have now run out of their excess savings, and are starting to see a credit spending on the increase now in the US. So they're starting to burn a little bit hot. That kind of, in combination with the right-hand side, where you see credit conditions are very much tightening, those two things together mean that you would expect consumer confidence to really start slowing down over the next 12 months. There's been US consumer confidence has really helped power them through an expected performance to positive this year. So with that reversal expected over the next 12 months, that's why I'm starting to talk a little bit more defensive, starting to position the portfolios so that they're more resilient in downturns. There's one other thing on top of COVID that's COVID related. So the US consumers are about to say farewell to nearly $16 billion a month of monthly spending power. So in the US, they had a moratorium on basically federal university loans. The Congress has got rid of that as of this month. That's going to change 15.8 billion. And when you look at the proportion of the population that is, it's more outsized on younger people, and these are people that have lower disposable incomes. So it's going to really start biting into them the most. Obviously, younger people tend to be quite more spending orientated rather than saving orientated. So it's going to have a more outsized effect from that point of view. You can see there that on a gross pay basis, this change is going to equate to around about 10% of incomes taken away, which is obviously a considerable amount. But actually, when you look at it on a net after tax basis, it's closer to 12% of incomes is going to be taken out from this huge sector of the population of the US. So that's why I think looking forward to the next 9 months, the more defensive posture could be really quite beneficial, moving up the credit cycle, so moving more towards, safer debt can help perform outsized returns within the portfolio. So that's quite positive. And just a repeat of what I mentioned. So as mentioned, we're kind of at peak rates now. I think this is really positive, really powerful, this graph. It shows what the difference is in returns between cash versus treasuries, bonds in general. And you can see quite clearly there that when you reach that peak rate, that's when cash returns stop outperforming bonds. And considering, it was 9% is the difference that's been over the last couple of years, you would expect there to be considerable outperformance of bonds for a while to come. As you can see, over the long term, bonds massively outperform cash. So I think that's really quite significant indeed. Why am I talking about US Treasury so much? Well, the correlation of what the US Treasury does compared to the rest of the world. So whilst the Fed is raising, it isn't quite so correlated whether or not the rest of the world raises rates. When the Treasury cuts, pretty much the whole world cuts. So what you'll probably find is that when the US starts cutting, will be when the UK starts cutting, it's when the ECB starts cutting, will be when the Bank of Australia starts cutting. So that's why we very much keep an eye on what's going on there. Pass through those because obviously I've been talking about that and they'll be included in the distributed slides. And talk forward to the next quarter. So as I mentioned, quarter four earnings have been on positive surprise. However, what I would say to that is that that's after earnings revisions downward during the quarter. So we haven't seen like a big bump up in S&P performance over the last couple of weeks, simply due to the fact that the earnings expectations have come down a little bit anyway. So they're not perhaps as positive as they might seem on the outset. Inflation, whilst I said about the headline rate coming down, core CPI is sticky, particularly in the UK and Europe, largely related to the jobs market. For that core CPI to really start coming down, something needs to break. And obviously, that's why recessionary factors are increasing. PMI data is starting to get very low in Europe. We're in the low 40s. And as mentioned there, jobs data, unemployment's picking up, and how much capacity is there to absorb? In the US, not quite so much, but they seem to have a stronger economy. In Europe, that story doesn't exist yet, and that's what's powering sticky CPI. So just looking at this heat map here of manufacturing PMI, and as I mentioned, you can see up here the Eurozone areas are now very negative. Germany now is 50 is basically considered to be neutral. Germany is now at 39, which is a very negative territory indeed. So we're starting to consider, have the defensiveness of our European assets. And then areas that are more positive, interestingly, are from more kind of like ASEAN areas, such as Indonesia, which is an area that we've been researching as China +1 is very much in flow. But also India is also very positive last print that came in was in the high 50s. So emerging markets seem to be more resilient at the moment, as I said, the China +1 topic, and not just that. The emerging markets didn't need to raise rates anywhere near as high as developed markets, simply due to the fact of they didn't have these huge COVID support packages that the rest of the world had, and then had to fight the inflationary effects of later. So they've been able, actually, in some areas, they've already started lowering rates. So that's probably going to mean that emerging markets are a little bit out of a step, like one step ahead of developed markets for a little while, and that's something that we're very much keeping an eye on. Perhaps with emerging market government debt in hard currency, so that's in US dollars, looking possibly more positive over the next 6 months. Just very quickly there, just Connor's forecast on headline CPI. I think the UK figure here is more positive than perhaps I've seen elsewhere. I've seen UK forecast CPI, to hit 2%, somewhere like 2025 presently. It's something that's really quite changed somewhat. Obviously, as quantitative easing helps support asset values, quantitative tightening has the opposite effect on the right-hand side. But you can see there just how far we need to go to get rid of the effects of COVID. That has shrunk actually somewhat more than since that graph came back. As mentioned, credit conditions are tightening at a time when there's lowered confidence within the Eurozone. The two things together are not awfully positive, so that's why we're starting to be a lot more defensive in that area. And the US conditions are tightening as well, alongside the UK, which is as you would expect at this point. In fairness, it's not a huge surprise. Just quickly on banking risk, obviously, not just we had Silicon Valley Bank up at the beginning of the year, as you can see, talked a little bit there on the right-hand side. We had Metro Bank in the UK as well very recently. But what we see is that if there were a banking crisis, not that we're expecting one, that's one thing that's not on the radar for the next 12 months, is that we see that actually the core tier 1 capital ratios of banks is actually very healthy. So these are basically the capital that banks have to have for regulatory reasons, for stability. And as you can see, they're kind of like at all-time highs, which is very positive. When the likes of Silicon Valley Bank and Credit Suisse earlier this year had various difficulties, it was due to a mismatch. Well, in Silicon Valley Bank, it was due to a mismatching of liquidity. So they basically put their money in a little bit more duration mismatch, so as rate rises went up, they weren't able to pass those on immediately to deposit holders. Deposit holders took their money out. Problem was that their deposit holders were very concentrated, so that ended up with a bank run very quickly at Silicon Valley Bank. Interestingly, over half of those deposits went to large domestic banks, so far more stable institutions. So we're not expecting the banking risk kind of increasing somewhat over the next 12 months, especially as banks have already taken onto their balance sheets quite large contingent losses for potential increased loan defaults over the next couple of years. As mentioned there, we've had, looking back 12 months, a lot more positive figure thinking about 2024. It's slowing down somewhat now. The UK, somewhat of an outlier as well, but it's negativity. That's why we're moving probably more away from mid cap into large cap in the UK. And so one area, as I said, we're kind of like peak now. Treasury yields or near to, certainly on the short end. We see that as yields are falling on the treasuries, we'd be expecting growth, US, etc., to perform more than certainly UK in value. So that's another reason why we'd be looking at the UK mid-cap a little bit more. And then just look at what we're thinking of for the next couple of months. So I literally just came off of a call before the meeting with a structured product fund, looking at adding that potentially into the portfolio. Obviously, we need to work out how that's going to work. We could be very positive in either sideways or a more of a downturn market. These funds have the potential that if they have as a rule that they won't accept products that don't have a final measurement figure of less than 65%. So what that means is that they can produce a positive return in up to minus 35% performance scenarios. So obviously that can produce significant alpha in a downturn, but also they can produce alpha as well in a sideways market. So quite positive there. Introducing infrastructure as well, had a very positive meeting yesterday on that regard, which was kind of more looking at more sticky income, and not just that, their capital values of infrastructure is more sensitive because they're very long income again on more kind of a tail end of interest rates. As they've come up an awful lot over the last few months, they're going to be a lot less sensitive to capital depreciation on that one, as Mark alludes to, monitoring hypnosis. Investigating possibly the application of ASEAN, kind of running out of time now, but more than happy if anyone wants to talk to me on that one at the expense of China. Talked about the UK large cap, mid cap situation and the duration exposure and sovereign debt. And as obviously in that moment, it's very important to monitor the credit worthiness of our fixed income funds and how they are exposed. A lot of them are avoiding maturities of 1 to 2 years, not for interest duration reasons, but more as a fact of avoiding the rollover risks. They're looking at stuff that's dated further out, which I think is quite interesting. And that concludes. So sorry I sped through the last couple of slides. Unfortunately, I tried to fit in far more information than perhaps I gave myself time for. But I'm more than happy to field any questions as well.
Thank you, Sam. We actually haven't had any questions come through. So if anyone's got any last minute ones that they want to pop in the box over to the right, then please do. Our next webinar will be coming up in November. I believe it's going to be the 23rd of November. We will have Greg Armstrong with us to discuss protection policies. So you guys should receive some invitations for those. And as usual, you will receive the slides and the recording of this webinar. We normally try and send it out within 24 hours of the presentation. So if you have any questions on the back of that, obviously, then please don't hesitate. I'm sure Sam and Mark will be on hand to answer anything that you have. I am going to put the small survey up if we don't have any questions come through, and leave it up for the next kind of 10 minutes or so. So if anyone does have any time just to fill that out for us, obviously we would really appreciate it. Otherwise, we will see you guys at the next one.
Thanks for your time, everyone. And yeah, as Jess said, really appreciate any queries, any feedback. One thing really look forward to is engagement with clients. So yeah, please, if you have questions, honestly, I don't care if you think it's I don't want to look silly, questioning out. And sorry, did my microphone cut out there? Yeah, so yeah, honestly, never such a thing as a daft question, even if it might seem your word is really simple. Fire it across, more than happy to answer.
Okay. All right. Okay, thank you, everyone. See you soon.